For decades, the world has known China as an unstoppable economic force. It built cities faster than anyone in history. It lifted hundreds of millions out of poverty. It became the factory of the entire planet and a rising financial superpower. But beneath that image of strength, something dangerous has also been quietly building. Not a market crash, not a trade war, but a hidden chain of debts, risks, and systemic cracks. A financial time bomb buried inside the world's second-largest economy. Today, we're taking a look at the 5 factors that could cause that bomb to go off, and why the shock could reach every corner of the globe. China's skyline is a testament to decades of ambitious infrastructure building, glittering skyscrapers, vast highways, high-speed rail connecting bustling cities. But beneath this modern grandeur lies a troubling reality. A mountain of debt quietly amassed by local governments that could shake not only China's economy but the global financial system. For years, Beijing pushed growth through infrastructure. Provincial and municipal leaders were rewarded for delivering rising GDP, and the easiest way to achieve that was to pour money into building airports, stadiums, bridges, industrial parks. The catch? Local governments in China have very limited power to raise revenue through taxes. Instead, they leaned on something called local government financing vehicles, or LGFVs. LGFVs are essentially special-purpose entities created to borrow money on behalf of local governments. They allowed officials to fund massive projects without those debts appearing directly on the government's official balance sheet. On paper, the finances looked manageable. In reality, the obligations pile up in the shadows. The size of this hidden debt is staggering. Official statistics don't tell the full story, but independent analysts estimate that China's local government debt now exceeds $12 trillion, which is more than the entire GDP of Japan, the world's third-largest economy. The off-balance sheet borrowing worked as long as land sales kept generating cash. For years, local governments made money by selling land use rights to property developers who are eager to buy and build. But with China's property market now slowing, that revenue stream is drying up fast. The debts, however, remain. Because LGFVs operate in a gray area between public and corporate finance, the debt they issue is often intertwined with China's broader banking system. Domestic banks, many of them state-owned, hold large amounts of LGFB bonds. That means if these vehicles start missing payments, the shock could ripple through the financial sector. The problem is not just the size of the debt, but its opacity. Investors, analysts, even policymakers outside Beijing can't see the full picture because so much of it is hidden in quasi-corporate entities. Assessing risk becomes guesswork. And in financial markets, uncertainty is often as dangerous as bad news. The moment a few LGFBs fail to roll over their loans, fear could spread rapidly, first through domestic banks, then to global investors who have exposure to Chinese bonds. The stakes are high because local government debt is not just a technical issue. It's tied to the credibility of Beijing's economic management. For decades, China's leadership has projected an image of control, a steady hand guiding growth, keeping markets stable. If local governments begin defaulting on a large scale, that image could crack. And in a country where public trust is closely linked to political stability, even a small crack can have outsized consequences. For decades, China's property market has been more than just a sector of the economy. It has been the most single important pillar of national growth and personal wealth. When we count both direct contributions from construction and indirect effects like steel, cement, home appliances, and local government revenues from land sales, real estate makes up as much as 30% of China's GDP, one of the highest shares anywhere in the world. For many years, this was a story of unstoppable expansion. Vast new apartment complexes rose in cities large and small. Cranes dotted skylines. Local governments auctioned off land to developers, collecting massive revenues that helped fund infrastructure. And for Chinese households, buying property wasn't just about having a place to live. It was the default investment strategy. In China, nearly 70% of household wealth is tied up in real estate. a much higher share than in most developed economies where people also hold stocks, bonds, and pensions. Apartments became the primary savings vehicle, especially because the stock market is volatile and formal pension coverage is limited. Parents often buy homes for their children as part of marriage expectations, further inflating demand. But China's property boom had a secret. It was built on borrowing at an unprecedented scale. Developers like Evergrande, once the world's most valuable real estate company, became famous for an aggressive growth strategy, buying up land far in advance, starting multiple projects at once, and financing it all through bank loans, bond sales, and pre-sales to home buyers. At its peak, Evergrande had more than 1,300 projects in over 280 cities and owed over $300 billion to banks, suppliers, and investors. This debt-fueled model worked as long as property prices kept rising and sales remained brisk. But by 2020, the government, worried about overheating and systemic risk, introduced the 3 red lines policy. Stricter rules on how much developers could borrow relative to their assets, equity, and cash flow. That was the turning point. When sales slowed, companies like Ever suddenly found themselves unable to roll over debt or start new project. Pre-sales, which were a critical source of cash, dried up as buyers lost confidence. Suppliers went unpaid, construction stalled, and home buyers in some cities even staged protests, refusing to pay mortgages on unfinished apartments. By late 2021, Evergrande defaulted, the largest corporate default in China's history, sending shockwaves through the property sector. Other major developers like Country Garden and Sunac began to face similar liquidity crunches. By 2024, property sales had fallen by over 20% from their 2021 peak. A new construction stance had dropped to their lowest level in more than a decade. For millions of Chinese families, their home was not just a place to live. It's their retirement fund, their inheritance for their children, and their emergency safety net. A falling property market strikes directly at the heart of household wealth. In 2025, in many smaller cities, prices are down 15 to 20% from their highs, wiping out years of gains. Even in Tier 1 cities like Beijing and Shanghai, growth has slowed to a crawl, with some districts seeing modest declines. When people feel poorer, they spend less. Youth unemployment rates hover above 14%, and consumer confidence, already shaken by years of CO lockdowns, have taken another hit. Weak consumption makes it harder for Beijing to rebalance the economy away from investment growth. The real danger is not a sudden collapse, but a drawn-out stagnation in property values, similar to what Japan had experienced. A protracted property bust would mean years of weak sales, slow price declines, and cash-strapped developers struggling to survive. This would weigh heavily on GDP growth. Remember, real estate is almost a third of the economy and could trap banks with piles of bad loans tied to over-leveraged developers. More subtly, it erodes faith in one of the central pillars of China's economic model, the belief that property values always go up. If that belief dies, households may stop buying altogether, creating a self-reinforcing downturn. Another factor undermining China's financial stability lurks in the shadows. Beyond the brightly lit branches of China's state banks lies a vast and largely unregulated financial network known as shadow banking. It's not a single institution, but an intricate web of trust companies, wealth management products, entrusted loans, and even underground lending operations that operate outside the formal banking system. On paper, these products can look professional. Glossy brochures, polished sales pictures, and promises of steady returns give them an air of credibility. But behind the marketing, the reality is much riskier. Much of the capital raised is funneled into property developments that banks won't touch, or local government projects with questionable prospects of repayment. These range from industrial parks and bridges to entire new districts that may never reach full occupancy. What makes this even more concerning is the source of the funding. A significant share comes from middle-class households, not professional investors. For millions of Chinese families, shadow banking products seemed like a safe way to grow their savings, safer than the volatile stock market, and offering better returns than standard bank deposits. Many bought in under the assumption that the state would step in if anything goes wrong. In China, this belief in government protection runs deep. But there's no blanket guarantee, and when defaults occur, investors often discover that the safety net they thought they had doesn't really exist. This has already played out in high-profile cases. In 2023, the Zhongji Enterprise Group, one of the country's largest shadow banking conglomerates, announced it could not repay billions to its investors. Many of those left in limbo were ordinary citizens now facing the loss of life savings they had spent decades building. The scale of the problem is hard to overstate. At its peak, the shadow banking sector in China was estimated to be worth over $12 trillion, roughly equivalent to the GDP of the entire European Union. Even after years of regulatory crackdowns, it remains a multi-trillion-dollar force.